Stop chasing money. That sounds irresponsible, doesn't it? Every headline, every productivity podcast, every finance influencer has drilled the opposite into your nervous system. Earn more, scale harder, hustle earlier, retire faster, outpace inflation, outperform your peers, outrun irrelevance. Money has been framed as the finish line. But here is the pattern interrupt. The more aggressively you chase money, the more structurally it escapes you. Not because money is evil, not because ambition is wrong, not because success is unattainable, but because chasing is the wrong mechanic. This is the trap, and almost nobody sees it while they are inside it. Look closely at the pattern. When you chase something, you position yourself behind it. You create psychological distance. You reinforce the belief that it is ahead of you, scarcer than you, faster than you. Chasing money conditions your identity around pursuit rather than possession. It subtly programs your nervous system into survival mode. And survival mode does not build wealth, it consumes it. This is not philosophy, it is structure. Think of wealth like gravity. Gravity does not respond to effort. It responds to mass. The more mass you accumulate, the stronger the pull. Planets do not chase asteroids. They attract them. In finance, capital behaves similarly. Money flows toward stability, toward leverage, toward structured systems that can absorb and multiply it. Yet most people are sprinting after paychecks, and sprinting creates exhaustion. Exhaustion creates urgency. Urgency destroys judgment. This is where the architecture reveals itself. You were taught that income equals wealth, but income is velocity without direction. A high salary without structure is like revving an engine in neutral. It feels powerful. It sounds impressive. It goes nowhere. Meanwhile, someone earning less but structuring assets quietly builds mass. One is chasing. One is attracting. And here is the uncomfortable truth beneath the surface. Chasing money often masks anxiety. The silent fear of not being enough. The quiet comparison to classmates, siblings, colleagues. The subtle panic when inflation rises, markets drop, or layoffs trend. You may not say it out loud, but you feel it. The late-night calculations, the constant checking of account balances, the mental math in grocery aisles. It is not greed. It is uncertainty. And uncertainty makes humans move faster than necessary. Biologically, when resources appear scarce, the brain shifts toward immediate acquisition. Short-term gains feel urgent. Long-term positioning feels abstract. So you optimize for income spikes, bonuses, quick flips, side hustles, over time. And each spike creates a temporary high. Then adaptation sets in. The new baseline becomes normal. Expenses expand. Lifestyle inflates. Comparison escalates. And suddenly, the number that once felt liberating feels insufficient. So you chase again. This is the endless loop. The hedonic treadmill applied to finance. You think the solution is more. But more income without structural change amplifies instability. Here is the deeper system most people never examine. Money is not primarily earned. It is positioned. Income is earned. Wealth is positioned. That distinction changes everything, because if wealth is positioned, then chasing is irrelevant. Instead, structure becomes dominant. And when structure becomes dominant, psychology becomes critical. Let me introduce a metaphor from physics. In thermodynamics, systems move from order toward disorder unless energy is intentionally structured. Left alone, entropy increases. Personal finance behaves similarly. Without design, money disperses. Without constraints, spending expands. Without intention, capital fragments. So when you chase money, you're adding fuel to a system that leaks. It feels productive. It feels ambitious. It feels responsible. But underneath, the container is cracked. And this is why intelligent, disciplined people with impressive incomes still feel financially fragile. The issue is not effort. The issue is architecture. Now consider this. If chasing money worked, high earners would consistently become financially free. But many do not. They become high-income dependents, locked into lifestyles that require continued performance. Their stress rises with their salary. Their commitments expand with their bonuses. Their margin shrinks as their identity inflates. And here is where the emotional tension intensifies. Because stepping off the chase feels dangerous. What if I slow down and fall behind? What if others surpass me? What if opportunity disappears? These fears are predictable. They are human. They are not weaknesses, but they are signals that the system you're operating inside rewards motion over mastery. This is where most people double down. They work longer. They diversify side hustles. They monitor markets obsessively. They confuse activity with strategy. But strategy is subtraction before addition. Strategy asks, what am I optimizing for? If the answer is more money, the system has already trapped you. Because more has no endpoint. More compared to whom? More relative to what? More until when? Or an undefined target guarantees perpetual pursuit, and perpetual pursuit prevents arrival. The real question is not how to make more money. The real question is, what is money supposed to do for you? Security? Autonomy? Time? Options? Status? Relief? Until that is clarified, the chase continues blindly. Now imagine a different orientation. Instead of chasing income, you build systems that attract cash flow. Instead of maximizing lifestyle, you maximize leverage. Instead of measuring success by earnings, you measure by optionality. Optionality changes the equation. When you have options, urgency decreases. When urgency decreases, clarity increases. When clarity increases, decision quality improves. When decision quality improves, capital compounds. Notice the shift. We moved from speed to structure, from pursuit to positioning, from reaction to design. But to make this shift, something uncomfortable must happen. You must question a belief that has likely shaped your entire adult life. The belief that money equals safety. Money can contribute to safety. But safety built solely on income is conditional. It depends on performance, on employment, on markets, on health, on timing. Structural wealth, however, reduces dependence on constant performance. It builds layers, cash reserves, income-producing assets, skills that generate value, independent of employer approval. It networks based on mutual respect rather than status comparison. This is not about withdrawing from ambition. It is about redefining it. Because ambition without direction leads to burnout. Ambition with structure leads to autonomy. And autonomy is the real currency most people are seeking when they chase money. But here is the paradox. The moment you stop chasing money directly and start engineering value systems that solve real problems, build assets, and reduce fragility, money tends to follow. Not instantly, not magically, not predictably, but probabilistically. It becomes a byproduct rather than the objective. And when money becomes a byproduct, psychological pressure decreases. You make better decisions. You negotiate differently. You walk away from misaligned opportunities. You choose long-term plays over short-term validation. This is where power quietly shifts. Not dominance, not control. Clarity. And clarity compounds faster than cash. In the next section, we will dissect the invisible financial architecture you were likely handed without realizing it. The rules that shape your decisions before you consciously make them. The structural incentives that keep you running even when you're exhausted. The system that rewards chasing and subtly penalizes building. Once you see it, You cannot unsee it. And that is when the real shift begins. The invisible financial architecture. You were not born chasing money. You were positioned into it. That distinction removes shame. Because if the chase feels automatic, compulsive, almost reflexive, it is not a character flaw. It is conditioning. This is where the invisible architecture begins. From early childhood, performance is measured externally. Grades, rankings, awards, comparison. Effort is linked to reward. Obedience is linked to safety. Output is linked to approval. The system is not malicious. It is efficient. But it quietly teaches one core principle. Value yourself by measurable output. When you enter adulthood, money becomes the primary measurable output. The scorecard shifts from report cards to income statements. And here is where the structural mechanics tighten. Your cost of living increases faster than your financial literacy. Your exposure to status increases faster than your capital base. Your access to credit expands before your discipline stabilizes. Work your given tools without structural training. Credit cards before capital reserves. Loans before asset education. Income goals before asset frameworks. This is not personal failure. It is system sequencing. And sequencing matters. Imagine constructing a building. If you erect the upper floors before reinforcing the foundation, the structure becomes fragile under pressure. Most people build income floors before laying financial foundations. The result is anxiety, disguised as ambition. Now pause and examine something uncomfortable. Why does society celebrate income more than asset stability? Because income is visible. Assets are silent. Visibility fuels comparison. Silence builds leverage. The architecture rewards visible performance. Bonuses are celebrated. Raises are announced. Titles are updated publicly. But no one applauds your cash reserve ratio. No one posts about reducing liabilities. No one congratulates you for declining lifestyle inflation. Where the incentives are misaligned. This is the first cognitive shift. The system encourages earning over structuring. Earning creates autonomy. Activity keeps you engaged in the machine. Autonomy reduces dependency on it. This is not cynicism. It is pattern recognition. Let's examine the mechanics. You graduate. You pursue higher income. You upgrade living conditions. You upgrade social environments. You upgrade expectations. With each upgrade subtly recalibrates your baseline. Behavioral economists call this adaptation. But adaptation in a consumption-driven environment creates escalation. Your identity begins attaching to income tiers. I am someone who earns this. When income becomes identity, volatility feels like identity threat. And identity threat produces defensive decisions. You hesitate to take calculated risks. You accept roles misaligned with your long-term goals. Yet you tolerate stress levels that erode clarity. This is where intelligent people become trapped. Not because they lack intelligence, because the structure rewards short-term stability over long-term positioning. Now observe another layer. Most career paths are linear. Income increases gradually. Lifestyle increases proportionally. Expenses stabilize at a new level. But assets do not grow linearly. They grow exponentially, when structured correctly. This mismatch between linear income growth and exponential asset growth is rarely explained early. Instead, you are taught to increase income and assume wealth will follow. Often it does not. Because wealth is not a function of earnings alone. It is a function of retained capital multiplied by intelligent allocation. Retained capital requires restraint. Intelligent allocation requires patience. Patience requires emotional regulation. Now, none of those are emphasized in early financial socialization. You're rewarded for speed. You're praised for output. You're compared based on earnings. And so the chase begins. Let's zoom out further. There are three dominant financial archetypes embedded in modern economies: the earner, the consumer, the asset builder. Most people oscillate between the first two. The earner focuses on maximizing income. The consumer focuses on maximizing lifestyle, while the asset builder focuses on maximizing leverage. Notice the difference. The earner asks, "How can I make more?" The consumer asks, "What can I upgrade?" The asset builder asks, "What produces cash flow independent of my daily effort?" That final question changes trajectory. But it feels less exciting at first, because asset building lacks immediate dopamine. No applause, no social validation, no dramatic spikes, just quiet accumulation. And quiet accumulation feels slow compared to income acceleration. Here is where the architecture tightens again. Marketing systems amplify urgency. Social media amplifies comparison. Economic headlines amplify fear. These inputs create perceived scarcity. Perceived scarcity increases spending impulses and income urgency simultaneously. You feel pressure to earn more and pressure to display more. That dual pressure keeps capital circulating outward. It is not a conspiracy. It is incentive alignment. Businesses profit from your consumption. Employers benefit from your productivity. Financial institutions profit from your borrowing. Your stability is not their primary objective. Their objective is engagement. And chasing money increases engagement. If you slow down, reduce consumption, build assets quietly, your engagement decreases. This is why stepping off the chase feels countercultural. It feels like falling behind. But behind, relative to what? Fit a timeline constructed around visible performance metrics. This is where the second cognitive shift emerges. Financial freedom is not achieved by accelerating inside the existing structure. It is achieved by redesigning your relationship to it. Redesign begins with awareness. Awareness of cash flow patterns. Awareness of emotional triggers. Awareness of structural incentives pushing you toward earning rather than owning. Let's break this down mathematically. Lightly for now, deeper later. If you earn $150,000 annually and spend $140,000, your effective leverage is fragile. If you earn $80,000 and spend $50,000, your retained capital allows for asset acquisition. The higher earner appears successful. The second individual is structurally stronger. This is where perception diverges from reality. And this divergence fuels the endless trap. Because you compare visible income, not invisible structure. You see cars. You see homes. You see travel. You do not see debt ratios. You do not see stress levels. You do not see liquidity risk. The architecture thrives on partial information. Now, here is the deeper structural mechanic. Most financial stress does not come from low income. It comes from fixed obligations exceeding psychological tolerance, mortgages calibrated to maximum approval, car payments aligned with image, subscriptions layered invisibly, insurance optimized for minimum monthly cost, not resilience. Each fixed obligation reduces optionality. Optionality is the true stabilizer. When optionality decreases, pressure increases. When pressure increases, you chase harder. When you chase harder, you sacrifice strategic thinking. This is the loop. But loops can be interrupted. First, by reframing income as fuel, not identity. Fuel is stored strategically. Identity is defended emotionally. Second, by reframing expenses as commitments, not conveniences. Commitments reduce mobility. Conveniences can be adjusted. Third, by reframing wealth as margin. Margin of time, margin of capital, margin of decision-making. Margin absorbs volatility. Without margin, every unexpected expense feels catastrophic. With margin, volatility becomes manageable. This is why some individuals with moderate income sleep peacefully, while some high earners lie awake calculating risk. It is structural, not moral. You are not behind. You're likely misaligned, and misalignment can be corrected. But correction requires confronting one more uncomfortable truth. You may have been optimizing for applause rather than autonomy. Applause fades quickly. Autonomy compounds quietly. In the next part of this section, we will dissect how this invisible architecture shapes your day-to-day decisions without conscious awareness, and how to dismantle it without burning your life down. Because the goal is not rebellion. The goal is recalibration. The cost of optimizing for the wrong scoreboard. There is a scoreboard running in the background of your life. You did not consciously design it, but you're playing by it. And until you see it clearly, you will continue optimizing for outcomes that feel impressive, yet leave you structurally exposed. This scoreboard measures income growth, job titles, visible upgrades, social comparison, speed of advancement. It rarely measures liquidity, optionality, debt ratios, asset to expense coverage, stress resilience. This is not accidental. Visible metrics spread. Invisible metrics compound. Most people chase what is socially visible because social environments calibrate perceived success. When your peer group discusses salaries, not savings rates, you adapt accordingly. When promotions are celebrated publicly, but risk mitigation is silent, your brain associates status with upward income movement, not structural security. So the architecture does not need to force you. It nudges you. And nudges accumulate. Let's examine a common progression. You begin your career earning $60,000. You live modestly. You feel stable. Then income increases to $90,000. Your environment upgrades slightly. Your social circle shifts. Expectations recalibrate. At $130,000, your living situation expands. Travel becomes more frequent. You justify it as deserved progress. At $180,000, you feel accomplished. But your fixed monthly obligations have expanded proportionally. Your psychological baseline now assumes this income level. And here is the critical tension. Your lifestyle becomes dependent on continued performance at a specific level. You are no longer chasing money for growth. You are chasing it to maintain equilibrium. Maintenance mode is psychologically heavier than growth mode. Growth feels expansive. Maintenance feels defensive. And defensive psychology narrows decision bandwidth. You become cautious in the wrong ways and aggressive in the wrong ways. Cautious about reducing income. Aggressive about increasing it, but rarely strategic about reallocating it. This is the structural blind spot. Income growth without structural design increases fragility disguised as success. Now pause here. If you feel tension reading that, it is not criticism. It is recognition. Because almost everyone inside modern economic systems experiences this progression to some degree. The question is not whether you are participating. The question is whether you are participating consciously. Here is another invisible mechanic. As income rises, time perception changes. You begin to value convenience over margin. You outsource tasks. You pay premiums to save hours. You justify higher recurring expenses because time is valuable. That logic is partially correct. But without structural boundaries, convenience compounds into obligation. Convenience subscriptions, premium housing for proximity, higher maintenance assets. Each decision feels rational in isolation. Collectively, they reduce flexibility. Flexibility is rarely prioritized early because volatility feels distant. But volatility is not rare. It is cyclical. Markets shift. Industries contract. Health changes. Family obligations evolve. When volatility arrives, it's those with high fixed burn rates feel it first. This is where intelligent individuals often say, "I make good money." Why does this feel fragile? Because fragility is not about income. It is about dependency on continued performance, dependency on economic conditions, dependency on social validation. Let's introduce a structural lens. There are two primary financial states: performance-based stability, structure-based stability. Performance-based stability requires consistent output at a specific level to maintain equilibrium. Structure-based stability requires asset support that reduces reliance on continuous performance. Most professionals unknowingly build performance-based stability. They assume rising income equals rising security. But security without redundancy is conditional. This is where the trap tightens further. Your brain equates higher earnings with progress. So when anxiety rises, the instinctive solution is to earn more. But earning more inside the same fragile structure intensifies exposure. It is like adding horsepower to a vehicle with worn brakes. Acceleration feels powerful. Stopping becomes harder. Now let's remove personal blame entirely. The system incentivizes performance-based stability because it sustains economic activity. High earners with high expenses are predictable participants. They work consistently. They consume consistently. They borrow predictably. They remain engaged. Structure-based stability, on the other hand, gradually reduces urgency. It increases negotiating power. It increases choice. It increases selective engagement. And selective engagement decreases economic predictability. From a macro perspective, performance-driven participants fuel momentum. From an individual perspective, structure-driven participants build resilience. Neither is morally superior, but one leads to long-term autonomy. Now, this is why many individuals experience a strange emotional plateau even after income milestones. They reach six figures. They reach executive roles. They surpass family benchmarks. Yet anxiety does not disappear because the internal scoreboard was built on external validation. And external validation has no ceiling. There will always be someone earning more, spending more, displaying more. If your internal stability depends on outperforming visible peers, the chase continues indefinitely. This is not pessimism. It is structural mathematics. Now let's go deeper into psychological wiring. Humans are status-sensitive creatures. Status historically signaled survival advantage, resources, alliances, protection. Modern economies translate status into visible consumption. So when you upgrade housing, vehicles, travel, your brain registers increased standing. This creates a short-term sense of expansion. But here is the hidden cost. Status signaling is expensive. Security is quiet. And when you allocate capital towards signaling rather than stabilizing, you increase your exposure to status volatility. If your identity becomes linked to visible markers, any reduction feels like regression, even if that reduction improves long-term position. This is why stepping down temporarily, to restructure, to invest, to build, feels emotionally difficult. It can feel like moving backward. But structural repositioning often requires short-term invisibility. Invisibility challenges ego. This is where the third cognitive shift begins forming. Your financial life is not a race. It is a positioning game. Races reward speed. Positioning rewards foresight. Speed inside a flawed structure magnifies fragility. Foresight inside a modest structure compounds resilience. But foresight requires stepping outside the immediate feedback loop of applause and comparison. It requires tolerating temporary misalignment with social narratives. And that is psychologically demanding. This is why most people do not escape the endless trap. Not because they lack intelligence, not because they lack discipline, because they are rewarded continuously for staying inside it. In the next section, we will dissect the behavioral finance traps that operate beneath conscious awareness, the emotional triggers, identity-based spending patterns, and subtle self-sabotage mechanisms that intensify the chase, because architecture explains the structure. Behavior explains the repetition, the behavioral engine behind the chase. The architecture sets the stage. Behavior runs the script. You can understand financial structures intellectually and still sabotage yourself emotionally. That is not hypocrisy. It is human wiring. This is where the endless trap tightens, not through ignorance, but through predictable behavioral patterns. Let's begin with a quiet truth. Money decisions are rarely mathematical first. They are emotional first, mathematical second. And emotions move faster than spreadsheets. When income increases, the rational plan might be to raise savings rates, build liquidity, and acquire productive assets. But the emotional impulse says, I deserve to feel the upgrade. That word, deserve, is powerful. It signals compensation for stress, for long hours, for delayed gratification, for comparison wounds you never voiced. Spending becomes emotional reimbursement. This is not weakness. It is a reward loop. Dopamine spikes are immediate. Compounding returns are delayed. The brain favors immediate signals. Now layer status into this equation. When you upgrade visibly, you receive subtle reinforcement. Compliments, recognition, internal pride, reduced insecurity. Temporarily, your nervous system begins associating spending with identity stabilization. This is the first behavioral trap, identity-based consumption. You do not buy the car for transportation. You buy the narrative it supports. You do not upgrade the apartment for square footage. You upgrade for proximity to perceived success. And here is where it becomes subtle. Even minimalists chase money, just with different narratives. I am financially disciplined. I am ahead. I am smarter than consumer culture. Identity attaches either way. The trap is not consumption alone. The trap is linking self-worth to financial behavior in either direction. Now let's introduce loss aversion. Behavioral economics demonstrates that humans feel losses more intensely than gains of equal size. If your lifestyle calibrates to $12,000 per month, reducing to $8,000 feels painful, even if $8,000 is objectively comfortable. Why? Because the reduction feels like loss. So instead of reducing lifestyle when stress increases, you attempt to increase income. The chase accelerates, where income volatility creates fear. Fear triggers urgency, triggers risk-taking. Sometimes that risk-taking is intelligent. Often it is reactive. You accept projects misaligned with long-term direction. You tolerate partnerships that erode clarity. You say yes when strategic patience would be wiser. Not because you are irrational, because you are protecting baseline identity. Now examine social comparison more closely. Social comparison is not inherently harmful. It can inspire growth. But in consumption-driven environments, comparison skews upward. You rarely compare downward. You compare laterally or above. So even when you achieve milestones, you recalibrate to someone ahead. There is always another tier, another income bracket, another lifestyle upgrade, another investment success story amplified online. This creates what psychologists call relative deprivation. You are objectively progressing. Subjectively, you feel behind. Irrelative deprivation fuels the chase. You earn more not because you lack enough, but because someone visible appears to have more. And here is the destabilizing layer. Social media compresses timelines. You witness curated highlights without context. You see the outcome without the risk profile, the acquisition without the leverage exposure, the celebration without the debt structure. Your brain absorbs snapshots and constructs narratives. If they did it by 30, monks, I should be there. If they exited at this valuation, I am late. If they travel like this, my lifestyle is insufficient. These thoughts are often fleeting, but repetition wires expectation and fuels pressure. Pressure fuels speed. Speed reduces strategic thinking. This is where the second behavioral trap emerges: acceleration bias. When you feel behind, you accelerate. You attempt to compress wealth timelines. You attempt to outpace discomfort. But capital formation rarely rewards emotional acceleration. It rewards consistency and asymmetry. Acceleration bias leads to over-trading, over-leveraging, over-committing, overextending credit. Each decision individually seems manageable. Collectively, they amplify fragility. Now let's examine another layer: scarcity imprinting. If you grew up around financial instability, your nervous system may interpret abundance differently. Some individuals overspend when income rises because scarcity trauma triggers enjoy it while it lasts. Others hoard excessively, fearing inevitable collapse. Both patterns are attempts to manage anxiety. Neither pattern alone creates structural wealth. Balanced accumulation requires emotional regulation, but emotional regulation is rarely taught in financial education. You're taught budgeting formulas, not impulse awareness. You're taught investment returns, not status sensitivity. You're taught tax efficiency, not identity detachment. So when anxiety spikes, you revert to familiar coping patterns. Work more, spend more, avoid looking at statements, or obsessively track them. All are responses to internal pressure. Now let's introduce the illusion of control. When you chase income aggressively, you feel proactive. Movement reduces helplessness. If markets decline, you work more hours. If expenses rise, you pursue side income. If inflation increases, you seek raises. Action feels stabilizing. But not all action increases resilience. Some action simply maintains exposure. This is the subtle difference between busyness and strategic positioning. Busyness satisfies anxiety. Positioning reduces fragility. They feel similar in the moment. Over time, they diverge dramatically. Now consider the sunk cost effect. If you have invested years into a specific career path, specific lifestyle tier, specific social circle, stepping back to restructure feels costly. I have worked too hard to downgrade. I have built this image. I cannot step back now. So you double down. Even when structural signals suggest recalibration, the sunk cost bias keeps you inside performance-based stability longer than optimal. Again, not because you are irrational, because identity is sticky. The more public your financial progress becomes, the harder it feels to shift direction. Visibility increases inertia. This is why some of the most capable professionals feel trapped inside success. Their competence has built a high-earning identity. Their expenses support that identity. Their social network expects that identity. So even if they recognize fragility, change feels reputationally expensive. Now pause. Notice what is happening. The endless trap is not built on ignorance. It is built on predictable emotional responses interacting with visible incentives. The system does not need to deceive you. It simply amplifies natural human tendencies: status sensitivity, loss aversion, acceleration bias, sunk cost effect, scarcity imprinting. These tendencies are universal to some degree. The question is whether you design around them or let them design you. In the next part of this section, we will examine how identity-based financial self-sabotage forms long before large income appears, and how to interrupt it without suppressing ambition. Because ambition is not the enemy. Unexamined ambition is. Identity, self-sabotage, and the status illusion. Before you ever earned significant money, you formed beliefs about what money means. Not consciously, through observation. You watched how adults reacted to bills. You noticed tension around certain purchases. You absorbed subtle commentary about rich people, struggling families, success, security. These impressions became identity scaffolding. And identity scaffolding quietly determines financial ceilings long before opportunity arrives. Here is the structural reality. You do not rise to the level of income you desire. You tend to rise and stabilize at the level your identity can emotionally tolerate. If wealth feels unfamiliar, threatening, or socially isolating, you may unconsciously destabilize progress. If modesty feels morally superior, you may underprice your skills. If visibility feels unsafe, you may avoid scaling. If high income feels tied to burnout, you may cap ambition. This is not mystical. It is pattern reinforcement. Behavior follows identity narratives. Now examine the inverse. If high income becomes your identity, you may unconsciously protect it, even when restructuring would strengthen you long term. Do you accept excessive workload because this is who I am? You maintain an inflated lifestyle because this is my level. You resist lower risk transitions because people expect this from me. Identity becomes financial gravity, and gravity resists change. This is the deeper trap inside chasing money. You think you're pursuing security, but you may actually be defending identity. Let's examine a common pattern. An ambitious professional surpasses their family's historical income levels. There is pride, relief, validation, but also subtle pressure. Now you're the successful one. Now expectations rise. Now stepping back feels like regression. So you continue pushing, not always because you need more, but because slowing down feels like betraying the identity others have anchored to you. This is how chasing money becomes socially reinforced self-sabotage. You sacrifice strategic positioning to maintain narrative continuity. The narrative becomes heavier than the math. Now let's introduce the status illusion. Status is relative positioning within a group, but wealth is structural positioning within an economy. They are not the same. Status can be purchased quickly. Wealth must be engineered patiently. Status depends on perception. Wealth depends on asset control and cash flow structure. When you chase money for status, you optimize for perception. When you engineer wealth for autonomy, you optimize for leverage. Perception fluctuates with audience. The leverage compounds with time. But status feels faster, and the human brain favors fast feedback. This is why lifestyle inflation often occurs precisely at income milestones. Promotion achieved, compensation increased, status upgraded. The internal narrative says, I have entered a new tier. So external markers are adjusted accordingly. The new apartment, the new wardrobe, the upgraded network environment. Each shift reinforces identity alignment. But here is the subtle structural issue. When lifestyle inflation matches income acceleration, retained capital does not increase proportionally. And retained capital is the raw material of asset formation. If you earn $200,000 and spend $180,000, your asset accumulation rate is slower than someone earning $120,000 and spending $60,000. Visible status diverges from structural leverage. This divergence fuels quiet anxiety. You may sense that despite progress, you're not structurally insulated, so you attempt to earn more. The chase intensifies. Now let's examine emotional spending triggers more precisely. Spending spikes often correlate with stress peaks, social comparison moments, milestone celebrations, conflict avoidance, self-soothing after setbacks. These are not random. They are regulation mechanisms. If your work week is intense, spending may function as psychological relief. If comparison increases exposure to perceived gaps, spending may function as identity reassurance. If conflict arises internally, am I behind? Spending can temporarily silence the question. But temporary silence does not equal structural resolution. The bill arrives later. The obligation becomes fixed. Optionality shrinks. This is where intelligent individuals rationalize. It is affordable. It is an investment in image. It will motivate me to earn more. Sometimes that logic works. Often it simply increases pressure. And pressure over time reduces strategic clarity. Now consider the illusion of linear progress. Most people believe financial life is a straight ascent. Earn more, upgrade more, save more, retire earlier. But real wealth formation often involves strategic plateaus, periods of consolidation, periods of invisibility, periods where income growth slows while asset positioning strengthens. Those plateaus feel uncomfortable inside a culture obsessed with acceleration. So individuals attempt to avoid them. They push for constant upward movement. Constant movement looks impressive, but it prevents deep structural reinforcement. This is similar to strength training without recovery. Continuous strain without consolidation leads to instability. Financially, consolidation phases allow debt reduction, liquidity expansion, asset acquisition, skill stacking. But consolidation lacks glamour, so it is often skipped. This is why many professionals reach high income yet remain vulnerable to shocks. They never allowed the consolidation phase to catch up to acceleration. Now let's examine self-sabotage more directly. Self-sabotage in finance rarely looks dramatic. It looks like small misalignments repeated. Underpricing services, overcommitting to expenses, avoiding investment research, ignoring cash flow tracking, delaying uncomfortable financial conversations. Each action individually appears minor. Collectively, they shape trajectory. Why do capable people avoid tracking net worth precisely? Because precision confronts narrative. If you believe you are ahead, data may challenge that. If you fear you are behind, data may confirm it. Ambiguity protects ego. Clarity strengthens structure. Chasing money often thrives in ambiguity. You focus on gross income. You celebrate revenue spikes. You track bonuses. But you avoid net asset position, because net asset position reveals structure, not performance. Performance is exciting. Structure is honest. This is where the behavioral trap becomes visible. Chasing money sustains emotional momentum. Engineering wealth demands emotional maturity. Maturity requires delayed gratification, not in extreme austerity. In strategic sequencing, you may want the visible upgrade. But structure asks, does this increase leverage or reduce it? You may want the income spike. But structure asks, is this sustainable or reactive? You may want rapid scale. But structure asks, does this increase fragility? These questions slow momentum. And slowing momentum feels uncomfortable in competitive environments. Yet speed without direction magnifies error. Now here is the critical inflection point. You cannot dismantle the endless trap by suppressing ambition. Suppression creates resentment. Resentment leaks into spending or risk-taking later. Instead, ambition must be redirected. From chasing income to building leverage. From optimizing status to optimizing optionality. From defending identity to expanding capability. But before we move into the mathematical frameworks and capital thresholds that operationalize this shift, you must confront one final behavioral illusion. More money will not fix an undefined target. If your internal definition of enough is unclear, income growth simply resets the baseline. And when the baseline resets, the chase resumes. In the next section, we will quantify this trap. We will model wealth velocity, capital thresholds, compounding asymmetry, and the numeric difference between earning more and structuring more. Because clarity without numbers is fragile, and numbers reveal what emotion conceals. The mathematics of the endless trap. Motion drives behavior. One behavior shapes structure. Structure's outcome. Now we quantify it. Because once you see the numbers, the illusion weakens. Let us define a simple but powerful variable: wealth velocity. Wealth velocity is not how fast your income grows. It is how fast your net worth compounds relative to your fixed obligations. Income growth without net worth acceleration is motion without distance. You can earn $300,000 per year and still have low wealth velocity. You can earn $90,000 per year and have high wealth velocity. The difference is retained capital and its allocation efficiency. Now, we introduce a structural equation. Net worth growth equals income minus expenses plus return on existing assets. Most people obsess over the first half of that equation. Increase income, reduce expenses. But the second half is where exponential behavior begins. Return on existing assets. This is where compounding lives. This is where chasing money collapses. Let's model two individuals over a 10-year period. Individual A. Income: $220,000 annually. Expenses: $200,000 annually. Retained capital: $20,000 annually. Assume they invest that $20,000 with an average 7% annual return. After 10 years, ignoring volatility, their investment contributions total $200,000. With compounding at 7%, the portfolio may grow to approximately $275,000 to $290,000. And now, individual B. Income: $110,000 annually. Expenses: $60,000 annually. Retained capital: $50,000 annually. Same 7% annual return. After 10 years, contributions total $500,000. Compounded at 7%, the portfolio may approach $690,000 to $720,000. Individual A earned twice as much. Individual B accumulated over twice the wealth. This is not about minimalism. It is about structural leverage. Now consider the psychological layer. Individual A feels successful. High income. Visible status. Prestige signals. Individual B may appear moderate. Yet structurally, individual B has greater optionality. If a downturn hits, individual A must protect income. Individual B has asset support. If individual A loses employment, lifestyle contraction is severe. If individual B loses employment, liquidity buffers extend runway. This is wealth velocity. It measures structural momentum, not performance noise. Now let's deepen this. Compounding behaves non-linearly. The first $100,000 invested compounds slowly. The first $500,000 accelerates. The first $1 million shifts psychological and structural reality. Why? Because returns are proportional to capital. At 7%, $100,000 generates $7,000 annually. $1 million generates $70,000 annually. At 10%, $100,000 generates $10,000 annually. $1 million generates $100,000 annually. Notice the inflection. When investment returns approach your annual living expenses, is performance-based stability transitions toward structure-based stability. This is the capital threshold. The threshold where asset returns materially reduce reliance on labor income. Most people never calculate this number. They chase income milestones instead. 6 figures, $250,000, $500,000, 7 figures. But income milestones do not automatically reduce dependence. Capital thresholds do. Now let's define it more precisely. Capital threshold equals annual essential expenses divided by expected conservative return rate. If your essential annual expenses are $60,000 and you assume a conservative 5% long-term return, $60,000 divided by 0.05 equals $1,200,000. At $1.2 million invested at 5%, your portfolio may generate $60,000 annually before taxes and volatility adjustments. This does not guarantee stability. Markets fluctuate. Returns vary. But structurally, your dependence on earned income decreases dramatically. So this is not about early retirement. It is about reduced fragility. Now contrast this with chasing income. If your income rises to $300,000, but expenses rise to $240,000, your capital threshold increases. At $240,000 annual expenses, $240,000 divided by 0.05 equals $4,800,000. Your target multiplies. The chase accelerates. This is the mathematical core of the endless trap. When expenses scale with income, capital thresholds expand faster than assets accumulate. You feel wealthier. You are structurally further from autonomy. Now introduce another layer. Time. Compounding rewards, early positioning. If you invest $50,000 annually starting at age 25 for 15 years and stop at 40, assuming 8% return, those contributions may grow significantly by age 60. If instead you begin at 40 and invest $50,000 annually for 20 years, you may contribute more total capital but end with similar or lower terminal value due to lost compounding runway. Snuffed time multiplies capital more than effort alone. Chasing income early at the expense of asset formation sacrifices time leverage. This is why early lifestyle inflation is disproportionately expensive. A $30,000 annual lifestyle upgrade at age 28 does not just cost $30,000. It costs decades of foregone compounding. Let's quantify that. $30,000 invested annually at 8% for 30 years. Future value approximately $3.4 million. That recurring lifestyle expansion may cost millions in foregone capital over a long horizon. Now pause. This is not a call for austerity. It is a call for awareness of sequencing. Early retained capital is exponentially more powerful than late retained capital. So the question becomes, are you using your highest leverage years to build capital mass or to expand lifestyle mass? Mass determines gravity, and gravity determines attraction. Now let's introduce wealth acceleration through asymmetry. Not all returns are equal. There are three primary return drivers: linear income growth, market-based compounding, asymmetric upside opportunities. Linear income growth is predictable, but capped by time and capacity. Market-based compounding grows capital steadily, but requires patience. Asymmetric upside, equity stakes, ownership positions, scalable systems, can produce non-linear returns. However, asymmetric opportunities require surplus capital and risk tolerance. If all your income supports fixed obligations, you cannot pursue asymmetry safely. Chasing money through salary alone limits exposure to asymmetry. Building capital enables asymmetry. This is where the trap reveals its deeper cost. When you focus exclusively on increasing income, you limit time and mental bandwidth for asset positioning. You become optimized for performance, not ownership. Performance pays. Use ownership multiplies. But ownership requires patience, retained capital, and strategic thinking. Now consider wealth velocity again. If your annual retained capital is $10,000 at 7%, your compounding curve is shallow. If it is $70,000 at 7%, your compounding curve steepens significantly. If you allocate portions toward higher upside ownership with calculated risk, the curve steepens further. The difference over 20 years becomes structural, not marginal. Chasing income from $200,000 to $240,000 may feel powerful, but increasing retained capital from $20,000 to $70,000 changes trajectory dramatically. This is why net savings rate often matters more than gross income growth. A 50% savings rate at moderate income can outperform a 10% savings rate at high income. Yet savings rate is invisible. Income is visible, so the chase targets visibility. Now let's introduce debt. Not all debt is destructive, but high consumption debt reduces wealth velocity. If $3,000 monthly services debt, car payments, and discretionary financing absorb retained capital, compounding stalls. Interest paid becomes negative compounding. Negative compounding is quiet but relentless. A 20% credit interest rate is mathematically devastating relative to 7 to 10% investment returns. If you are earning 8% but paying 18%, your structural position erodes. Yet chasing money may mask this imbalance. Do you believe income growth offsets inefficiency? It rarely does sustainably. Now here is the pivot. You do not escape the endless trap by eliminating ambition. You escape by reallocating ambition toward capital formation and asymmetry. But to do that intelligently, we must understand why intelligent individuals, even with full awareness of these numbers, still fail to implement structural change. Because mathematics alone does not override social programming. And that is where we go next. Why intelligent people still fall into the trap. At this point, the math is clear. Retained capital compounds. Expenses inflate thresholds. Ownership multiplies. Performance alone plateaus. So why do intelligent, disciplined, financially literate individuals still get caught in the endless chase? Why do people who understand compounding still expand lifestyle too quickly? Why do professionals who can model risk still build fragile structures? Why do high performers often feel financially tense despite impressive income? The answer is not ignorance. It is environmental pressure layered over cognitive fatigue. Let's start with social programming. From early adulthood, progress is externally defined. Graduate. Advance. Earn more. Upgrade. The narrative is linear and upward. Pause is framed as stagnation. Consolidation is framed as lack of ambition. Downshifting is framed as regression. So when income increases, maintaining modest expenses can feel like violating expectation. Even if no one explicitly pressures you, the environment implies it. Your peer group moves neighborhoods. You feel the pull. Colleagues upgrade vehicles. You notice. Friends travel more frequently. You recalibrate your baseline. This is not envy. It is calibration. Humans unconsciously calibrate to their reference group. If your reference group's average monthly burn rate is $15,000, now living on $6,000 may begin to feel behind, even if $6,000 covers your needs comfortably. This is relative positioning pressure, and it operates quietly. Now add professional identity. If you work in a high-income field, finance, law, technology, medicine, visible success signals credibility. There is subtle alignment between income and perceived competence. So spending becomes symbolic reinforcement. You're not just buying housing. You're buying proximity to peers. You are not just leasing a vehicle. You are aligning with expected identity. This is how lifestyle inflation disguises itself as professional integration. You justify upgrades as necessary to fit the room. Sometimes that is strategically valid. But without structural boundaries, fitting the room turns into financing the room. And financing the room increases dependency. Dependency reduces optionality. Optionality reduces stress. Notice the inversion. The more you try to align with high-status environments through visible spending, the more you reduce structural freedom. Now let's examine decision fatigue economics. High earners often make hundreds of micro-decisions daily. Complex projects, high stakes, time-sensitive calls. Cognitive bandwidth depletes. When cognitive bandwidth drops, default behaviors take over. Default behavior in consumption-driven economies is spending. Convenience replaces scrutiny. Subscriptions replace analysis. Outsourcing replaces internal evaluation. Each decision saves mental energy in the moment. Collectively, they erode financial clarity. You tell yourself, I work too hard to micromanage expenses. I will optimize later. It is affordable. And often, individually, these statements are reasonable. But compounding works both directions. Small recurring inefficiencies, left unexamined, become structural drag. This is why intelligent individuals sometimes feel financially disorganized despite intellectual capability. Their cognitive energy is allocated to earning, not structuring. Performance absorbs focus. Architecture receives leftovers. Now consider another pressure: temporal compression. Modern career trajectories often accelerate quickly. Within 5 to 10 years, income may double or triple, but psychological adjustment lags. When income increases rapidly, the brain attempts to catch up with identity. You think, if I earn this much, my life should look like this. So upgrades occur quickly, but asset accumulation lags behind because assets compound slower than lifestyle adjusts. This gap between perceived income level and actual capital mass creates fragility. You feel wealthy. Your balance sheet may not yet support it. Now layer in environmental exposure. Urban professional environments normalize high fixed costs, luxury housing markets, premium schooling, high childcare expenses, social events calibrated to high price points. Even if you personally prefer moderation, the environment nudges you upward. This is not malicious. It is market segmentation. But if you build fixed obligations based on peak earning years, volatility becomes threatening. And volatility is cyclical. Industries contract, compensation structures shift, bonuses fluctuate. When expenses anchor to peak performance, even small income dips feel destabilizing. This is how intelligent individuals end up financially tense. They built for continuation, not for cyclicality. Now let's address lifestyle inflation psychology directly. Lifestyle inflation feels rational because it is gradual. You rarely double expenses overnight. You increase by 10%, then another 10%, then another. Over 5 years, modest increases compound into structural expansion. The issue is not comfort. The issue is irreversible commitments. Rent can increase gradually. Mortgage locks you in. Car leases renew. Private education extends for years. Flexibility decreases incrementally, and incremental reduction feels harder than incremental increase. Because reduction triggers loss aversion. You would rather work harder than shrink visibly. This is where chasing money becomes defensive, not to grow. To avoid contraction, defensive earning is exhausting. It lacks inspiration. It lacks asymmetry. It is maintenance under pressure. Now consider another layer: reputation inertia. If you become known as high-performing and high-earning, your social identity solidifies. Opportunities presented to you align with that identity. High-income roles, high-visibility projects, high-responsibility commitments. Saying no becomes psychologically difficult because refusal feels like underperformance. So you accept. And acceptance expands workload. Workload expands stress. Stress narrows bandwidth. Bandwidth, structural oversight. This is the silent compounding of fragility. Now pause here. None of this suggests withdrawal from ambition. None of this suggests rejecting growth. The insight is this: growth without structural recalibration increases exposure. Recalibration requires periodic reduction in visible acceleration, and visible deceleration can feel threatening inside competitive ecosystems. This is why even financially literate individuals remain inside the trap, because escaping requires tolerating temporary misalignment with social tempo. Now we approach a crucial pivot. If the system rewards speed, how do you build depth without losing momentum? If your environment expects visible success, how do you prioritize invisible leverage? If your industry incentivizes constant acceleration, how do you engineer strategic plateaus? This is where structure must become intentional, is not reactive. In the next section, we move from diagnosis to blueprint. We will design the capital structure that replaces chasing with positioning, step by step, layer by layer. Income as fuel, expenses as levers, assets as engines, risk as calculated exposure. Because awareness without implementation keeps you informed, but unchanged, and structural change begins now. The Strategic Wealth Blueprint. Diagnosis without design creates frustration. And you now understand the trap. Chasing income expands lifestyle. Expanded lifestyle raises capital thresholds. Raised thresholds intensify pressure. Pressure accelerates performance dependence. So we pivot, not away from ambition, toward structure. This is the strategic wealth blueprint, not a motivational framework, a capital architecture. It is built on 5 structural layers: financial ground stability, cash flow control system, asset acquisition engine risk mitigation framework, asymmetric expansion layer. Each layer reinforces the next. You do not skip layers, you stack them. Because speed without sequencing recreates fragility. Let's begin. Layer 1. Financial ground stability. Before assets multiply, the ground must absorb volatility. Ground stability consists of 3 metrics: liquidity ratio, fixed obligation ratio, burn rate visibility. Liquidity ratio: how many months of essential expenses can you cover without income? Not lifestyle expenses. Essential expenses: housing, utilities, food, insurance. Minimum debt obligations: if your essential monthly burn is $6,000, 6 months requires $36,000 liquid. 12 months requires $72,000. This buffer does not generate excitement. It generates optionality. Optionality reduces urgency. Reduced urgency improves decision quality. Or improved decisions increase long-term wealth probability. Without liquidity, every setback becomes emotional. With liquidity, setbacks become strategic. Next, fixed obligation ratio. What percentage of your net income is locked into non-flexible commitments? Mortgage or rent, car payments, long-term contracts, private tuition, subscription stacks. If fixed obligations exceed 50 to 60% of net income, flexibility narrows quickly. When flexibility narrows, chasing intensifies. Yes, the goal is not austerity. It is elasticity. Elastic structures absorb volatility. Rigid structures crack under it. Now, burn rate visibility. If you cannot state your true monthly burn within a narrow margin, you are operating on assumption. Assumption breeds overconfidence or unnecessary anxiety. Clarity stabilizes. This is not obsessive tracking. It is structural awareness. Ground stability is not glamorous, but it is the foundation of leverage. Without it, asset building becomes stress-inducing rather than strategic. Now we move to Layer 2. Layer 2. Cash flow control system. Most cash flow as leftover money. That is backward. Cash flow must be engineered before lifestyle expands. Your cash flow control system answers 3 questions. What percentage of income is non-negotiable retention? Where does retained capital automatically deploy? What spending categories expand only after retention targets are met? Why retention must be systematic. If savings depend on willpower, they fluctuate with emotion. Automation converts intention into structure. For example, 40% of net income retained automatically, 20% allocated to long-term investment vehicles, 10% allocated to opportunity fund, 10% allocated to tax planning or future liabilities. Numbers vary by context. The principle remains. Retention precedes expansion. Spending adjusts to remainder, not the reverse. This shift alone dismantles the chase mentality. Because instead of asking, "How much can I spend at this income level?" you ask, "How much capital can this income level produce?" Now, the psychological pivot: income becomes fuel. Retention becomes engine. Assets become output. You stop measuring progress by salary. You measure by capital mass. And capital mass determines gravitational pull. Now we move to the 3rd layer. Layer 3. Asset acquisition engine assets fall into 4 broad categories: market-based financial assets, income-producing real assets, business equity or ownership, skill-based income leverage. Each category carries different risk, liquidity, and asymmetry profiles. The objective is not random diversification. It is strategic layering. Begin with broad, low-cost, diversified market exposure. This forms compounding backbone. Not because it is exciting, because it is reliable over long horizons. Then layer income-producing assets where feasible, rental real estate, dividend-producing equities, royalty-based structures, partnership stakes. These assets shift you from pure performance-based stability toward hybrid stability. Hybrid stability reduces pressure. Now, the asymmetry layer. Ownership stakes in scalable ventures. Equity compensation structured intentionally. Small business equity with downside controls. Asymmetry means limited downside with significant upside potential. But asymmetry requires surplus capital and emotional discipline. If you deploy asymmetric capital without ground stability, volatility becomes destabilizing. This is sequencing again. Ground to flow, to engine to asymmetry. Now pause. Notice something critical. None of this requires extreme income. It requires disciplined allocation. High income accelerates process, but structure determines outcome. Now we introduce the fourth layer. Layer 4, mitigation framework. Chasing money often is risk until crisis appears. Structural wealth anticipates volatility. Risk mitigation includes insurance aligned with asset protection, not just minimum cost. Geographic diversification, where applicable. Income source diversification. Emergency liquidity, separate from investment capital. Legal structure for asset separation. The objective is not paranoia. It is insulation. Insulation reduces catastrophic risk probability. Reduced catastrophic risk allows confident long-term positioning. When risk is mitigated, you can pursue asymmetry intelligently. Without mitigation, asymmetry feels reckless. Now the fifth layer, and this is where everything integrates. Layer 5, asymmetric expansion strategy. This layer replaces chasing. Instead of increasing income linearly forever, you increase capital leverage. For example, using retained capital to acquire equity in scalable ventures. Using skills to negotiate ownership rather than salary alone. Using liquidity to enter opportunities during downturn cycles. Downturn cycles matter. When markets contract, those without liquidity retreat. Those with liquidity expand. Chasing money in expansion cycles feels easy. Building capital in quiet periods feels slow. Deploying capital in contraction cycles changes trajectory. This is how wealth velocity accelerates, not through constant hustle, through prepared positioning. Now, let's model integrated structure. Assume net income, $180,000 retention rate, 45% annual retained capital, $81,000 over 10 years at 8% compounded. Contributions total $810,000. Projected value may exceed $1.2 million, depending on consistency and returns. Add selective asymmetric exposure with controlled allocation, say 10 to 15% of retained capital toward higher upside ventures. If even one venture performs strongly over decade horizons, trajectory bends sharply. But this is only possible if your lifestyle does not consume all fuel. Now, the blueprint is visible. But blueprint without execution is theory. In the next part of this section, we will translate this structure into operational steps: month-by-month sequencing, capital stacking, and skill stacking models that make this blueprint realistic inside demanding professional lives. But because structure must integrate with reality. Operationalizing the blueprint. Blueprints inspire clarity. Systems create results. Now we translate structure into implementation. Because without operational sequencing, even the most disciplined individuals drift back into performance-based stability. This is where we engineer momentum without returning to the chase. Phase 1. Stabilization window. Months 0 to 12. This phase is not about expansion. It is about insulation. Non-step 1. Define essential burn rate precisely. Strip expenses down to non-negotiable core: housing, utilities, food, insurance, minimum debt, healthcare. This number becomes your structural baseline, not your lifestyle identity, your resilience baseline. Step 2. Build liquidity buffer. Target 6 to 12 months of essential expenses. If your essential burn is $5,000 monthly, target $30,000 to $60,000 liquid. This may take months or years depending on starting point. But during this window, retention rate takes priority over lifestyle expansion. This is where discipline replaces impulse. It may feel like delay. It is insulation. Step 3. Cap lifestyle inflation during stabilization. If income increases during this window, allocate increases primarily toward liquidity and investment. Temporary restraint compounds later. Remember, early retained capital carries exponential advantage. Now, during stabilization, you do not freeze life. You live, but you eliminate automatic upgrades tied to income spikes. Income spikes are directed to structure first. Once liquidity threshold is achieved, the emotional pressure decreases noticeably. You will feel it. Decisions slow down. Urgency fades. Negotiations improve. This is where the chase begins to weaken. Phase 2. Structural accumulation. Years 1 to 5. Now we build mass. This is where compounding becomes visible. Step 4. Lock in retention percentage. I set a non-negotiable retention rate: 30%, 40%, 50%. The number depends on context, but the principle is fixed. Retention is a rule, not a mood. Automation becomes critical. If capital deployment depends on manual action, inconsistency creeps in. Step 5. Establish core compounding backbone. Broad market exposure. Low cost, diversified, long horizon. This is not for excitement. This is for stability. It becomes the gravitational center. Step 6. Create opportunity fund, not separate from emergency fund. This capital is not for survival. It is for asymmetric deployment. Business equity. Distressed assets during downturns. Strategic partnerships. Without opportunity capital, downturns feel threatening. With opportunity capital, downturns create leverage. Now here is a key distinction. The emergency fund protects survival. The opportunity fund accelerates trajectory. They are not interchangeable. Phase 3. Skill stacking model assets compound. All skills compound differently. Skill stacking is the multiplier layer. Instead of chasing money by working more hours, you increase the value per hour through skill combination. For example, technical expertise plus communication, finance literacy plus negotiation, operational ability plus equity structuring, domain knowledge plus capital allocation awareness. Individually, each skill pays linearly. Combined, they increase probability of ownership access. Ownership creates asymmetry. You want to transition from paid for time to paid for leverage. Leverage can be capital leverage, intellectual property, distribution access, equity positioning. But leverage without competence is unstable. So skill stacking must precede leverage deployment. This is how ambition is redirected ethically and sustainably, not to dominate environments, but to increase value creation capacity. Value creation capacity attracts capital naturally. Month-flow architecture as assets accumulate. Cash flow sources diversify. Salary, dividends, rental income, business distributions, consulting, royalties. The objective is not complexity for its own sake. It is layered optionality. If one stream contracts, others buffer impact. Now, here is the structural threshold. When non-salary income covers 25 to 40% of essential expenses, psychological dependence on employment decreases meaningfully. When non-salary income covers 60 to 80% of essential expenses, career choices shift from necessity to preference. You do not need full financial independence to experience freedom. Partial coverage changes posture. Negotiation improves. Risk tolerance becomes measured rather than reactive. You select environments intentionally. This is structural freedom in motion. Phase 5. Long-term asymmetry. Now we introduce timing awareness. Markets expand and contract. Industries overheat and reset. If you retain capital consistently, downturn cycles become opportunity windows. For example, during economic contractions, asset prices often decline. Liquidity becomes scarce. Fear increases. If you are fully extended with high fixed burn, you retreat. If you have liquidity and low obligation ratio, you can acquire selectively. This is where wealth acceleration often occurs, not during visible boom periods, but during silent repositioning phases. So now, let's model 20-year trajectory under disciplined structure. Assume net income grows moderately over time, retention maintained at 40%, core investments compounding at 7 to 8%, periodic asymmetric exposure yielding occasional outsized returns. After 20 years, capital mass may reach several multiples of total earned income over that period. The individual who once chased $200,000 salary increases now commands capital leverage that generates equivalent or greater cash flow passively. So performance-based stability transitions toward structure-based autonomy. And here is the subtle but powerful shift. Money is no longer chased. It is managed. Income becomes strategic, not emotional. Now pause and notice something. None of this requires extreme austerity. None of this requires isolation. None of this requires abandoning ambition. It requires sequencing, clarity, and periodic resistance to visible escalation. In the next section, we will explore the acceleration phase, how to intelligently scale both income and assets simultaneously without re-entering the trap. Because growth is still desirable, but growth must serve structure, not identity. Money as infrastructure. All right, we've built income, we've built assets, we've built discipline, we've rebuilt identity. Now comes the shift most people never consciously make. Money stops being a target. It becomes infrastructure. And this is where things get interesting. Because accumulation is a game. Architecture is design. Different energy, different decisions, different questions. Let's begin with the central shift. You're no longer asking, how much can I make? You're asking, how do I want my life to operate? That question changes everything. Time architecture earlier phases optimize for income growth and capital mass. Now we optimize for time quality. Not just free time, intentional time. When your assets generate meaningful non-salary income, you unlock design options. Reduce work intensity without reducing stability. Choose projects based on interest, not necessity. Shift from operator to advisor. Batch work into seasons. Take extended pauses without financial regression time. Flexibility is the first real dividend of structural wealth. And it doesn't require complete financial independence. It requires partial independence. When fixed expenses are covered 50 to 70% by non-salary income, you already operate differently. You negotiate differently. You tolerate less nonsense. You take smarter risks. That's architecture beginning. Work architecture at this stage. Work becomes modular. Instead of dominant income source, you build layered streams, core professional income, equity stakes, cash-flowing assets, advisory roles, intellectual property. The goal is not chaos. The goal is redundancy. Redundancy creates resilience. Resilience creates calm. Calm creates better decisions. And here's the nuance. You don't chase diversification for its own sake. You diversify control. If one stream disappears, identity and lifestyle remain intact. That's power. Not flashy power, structural power, capital architecture. Now we zoom into portfolio structure. In accumulation, growth dominates. In architecture, balance dominates. Now you begin thinking in tiers. Tier 1, stability base. Low volatility, cash flow, capital preservation. Tier 2, growth engine equities, businesses, scalable assets. Tier 3, asymmetric optionality, sire risk, smaller allocation, outsized potential. Most people invert this. They overweight asymmetry emotionally. They underweight stability structurally. Architecture demands the reverse. Because once you have enough, the objective shifts from maximizing upside to minimizing fragility. So at this level, avoiding catastrophic loss matters more than squeezing incremental return. You don't need 25% annual gains. You need survivability across cycles, relationship architecture. This part is rarely discussed. Wealth without relational stability becomes isolating. Architecture includes transparent financial communication, shared values, alignment, estate planning clarity, defined decision rules. Money stress destroys more than volatility ever could. So clarity compounds in relationships the same way capital compounds in portfolios. Design this intentionally, not reactively. Impact architecture. Once personal stability is secured, impact becomes the next lever. But impact without structure becomes chaos. Philanthropy. Strategic impact asks, where can capital create leverage? Where can skill create systems? Where can mentorship multiply effect? You don't donate to feel good. You deploy to build durability. The same principles apply. Margin, optionality, leverage, control. The final shift. Enough. Here's the quietest and most difficult question in the architecture phase. What is enough? If you cannot define enough, the accumulation loop never ends. And if the loop never ends, architecture never begins. Enough is not laziness. It's calibration. It's knowing. The asset base that protects your lifestyle. The income floor that creates psychological safety. The work intensity that sustains energy. The risk tolerance that protects sleep. When those are defined, you stop escalating for escalation's sake. You design. And design is calmer than ambition, not less. The complete cycle. Let's zoom out one last time. Phase 1. Survival, earn, stabilize, escape fragility. Phase 2. Foundation, retain, invest, build margin. Phase 3. Acceleration, optimize income, multiply assets, control leverage. Phase 4. Identity evolution, shift from proving to positioning. Phase 5. Architecture, design time, structure work, protect capital, define enough. Most people never leave Phase 1 emotionally. Some reach Phase 3 financially, but remain psychologically in Phase 1. Very few reach architecture consciously. But once you do, money becomes quiet. It works. It compounds. It protects. Yes, it enables. And you stop chasing it, because it's finally doing its job. That's the end of the cycle. Now the only real question left is, are you building income? Or are you building infrastructure? Your move.